Well, hey, Lydia, how's it going?
Hi, Sarah. I'm good. How are you?
Doing great. Glad we got
Good.
our technical difficulties behind us and
Exactly.
are
Today
ready to
was a little
go.
bit of a challenge.
Sometimes it happens. So,
Technology's a love-hate. So go
no
ahead.
doubt, no doubt, it totally is. And, it's so interesting is, we keep talking about all the change and all the movement, all the things that are happening in real estate, because real estate by and large is a slow moving beast. Like
Right.
it
Right.
changes over a long time, but not lately. So I kind of want to dive into all the different features. So right now, when you think economically speaking, we're in really good shape. I mean, things are moving in the right direction. We're having improvement across the board. Residential real estate remains the strongest sector. And the market is just beginning to show signs of normalcy, which is awesome. Demand is very strong. It is slightly calming, and that's a good thing because we have a lot of fatigued buyers that really are excited about having, even if it's just a couple more options. Options are a good
Right.
thing. And so some of the reasons that we've had such incredible demand is, the pandemic accidentally created involuntary savings. People
Yes.
simply couldn't spend the money that they used to on, concerts and going out to eat and traveling. And so now that, the rainy day down payment fund all of a sudden filled up, or they hit their goals, or, all of a sudden didn't even know they could, but now they can because of it. So
Absolutely.
it really helped people kind of get into the market. And it's enabled that strong demand. And as our economy opens up, people are going to start spending that money more and going to all these events, and services are such a huge part of our economy. We want that to happen, but it may take us back into a normal cycle for demand, which again, normal is good, cycles are good. That helps us plan and be able to better advise our buyers and sellers. And then despite the movement towards normal, sales prices and appreciation rates are still very high. And inventory has increased, but it's still 77% below normal. And while demand still has decreased, it's still 8% above normal. And the supply and demand imbalance is so severe that it's probably going to take years to correct, which is why we can really expect sales prices to continue increasing. Hopefully
Yes.
it will slow that 18% year over year appreciation that we currently have now, because that's really unsustainable. Another thing to think on too is unemployment is improving. And I kind of think as kids go back to school in the fall, provided they're all open, that's also going to open up a lot of the parents that had to make the choice between kids and their jobs. So then now they get to go back to work. So we're going to
Right.
see even more people going back to work, again, reopening, the economy and having things growing in the right direction. And then adding into that, so we kind of have that's all going on, but at the same time, that's all those things are why we're seeing improvement in the forbearance numbers. So,
Right.
Lydia and I last talked 2 weeks ago, and we saw a huge drop in like a week ago or 2 weeks ago, and then again in the last week. So 2 weeks ago, we were about 4.9% of loans were in forbearance. We're down to 4.5%. So that's about 2.3 million borrowers are in a forbearance plan. And, that's a couple 100,000 fewer than 2 weeks ago, which is huge.
Right.
When you look at it by stage, the initial number in forbearance did decrease a little bit. It's about 13.1%. 82.1% are on extension. And so that is actually down a little bit. And more than 36% of borrowers that are on extension are now past the 12-month mark. So that's kind of a key thing. We're going to see a lot of people start coming out. Now, they do have some options for, further extensions. And then about 4.8% of the loans in forbearance are re-entries. And that is a significant increase from 2 weeks ago when it was 2.2%. So we are watching the numbers. They are kind of reshuffling in a way.
Yes.
And then we want to talk about what's going on with the exits. So of the people who are exiting forbearance, what's their situation like? And a little over 40% of them continued making their payments or were completely caught up by the time they exited. Huge, awesome, wonderful, right?
Right.
The amount of borrowers that are exiting their plan with no loss mitigation plan in place is that number is also increasing, and that's 14.6% of all exits. So that's not so good. Now there's some of the things though, as you think about it, these are the ones that you really want to talk to and let them know that they have options. Now there are other means for exiting a loan or exiting a forbearance. And so this is a really amazing quote that came out last week from Mike Fratantoni, who's the president and chief economist of the Mortgage Bankers Association. So this is what he said. He said, in terms of performance, more than 88% of homeowners who've exited into deferral plans, modifications, or repayment plans were current on their loans at the end of March. 88%, that's awesome. He continues to say, compared to 92% of all homeowners. So the accelerating economy in March helped more homeowners recover and become current in their mortgages, in addition to helping other homeowners with more stable financial situations exit forbearance. So we're seeing a lot of improvement, and these are positive numbers. Things can change on, it seems like a moment's notice, but right now we're moving in a pretty awesome direction.
Right direction. Yeah. And the economies, we're opening up here, and as states open up, people are spending money, things are going to go back to normal. People are going to get back to work. Kids are going back to school, which is all good for us. So, but we also are starting to see, on my end of it, we're starting to see more BPOs. So that is a bit of a concern. Not that all BPOs mean that they're foreclosures, but it is something that we are going to watch. I did speak to a homeowner a couple of weeks ago. He did a forbearance a year ago, and he did say that he was having a hard time, him and his wife were having a hard time getting caught up. So I said to him, the forbearances were short-term loan modifications. And the look on his face when I told him that was, oh my gosh, it's like the light bulb hit. And he was like, oh my gosh, I just did a loan modification and I didn't know I did that. So what I would say is options. You need to talk to your servicer and find out what your options are, because a lot of people don't realize, well, first off, a lot of people don't think that those forbearances need to be paid back, and that is not true. It is a loan modification.
Did he know that he had to pay it back?
I don't think he did, because I think this whole thing completely caught him off guard. So he didn't know he had to pay it back. And then when he found out he had to pay it back, he's now trying to get caught up, and he and his wife are having difficulties getting caught up. But he also didn't realize that the word forbearance means loan modification. And I think that's what is difficult, that the homeowners don't understand. And even a lot of realtors don't understand that. So we need to educate our client base and explain to them, if you did a forbearance, you basically did a loan modification. Now, what does that mean? That means that whatever amount of time, the 3 months, the 6 months, the 12 months, some of them are doing 18 months, they need to realize that that's got to get paid back, or the potential of them putting it on the back end is also an option. That, depending on servicer by servicer, some of those are going to end up being second mortgages, which people don't realize, that if it becomes a second mortgage, your interest rate is going to be much higher than the 3% that's out there right now. So they just have to understand that. The other thing is, they have to realize that they might not be charging late fees for these forbearances, but there are going to be penalties. And the reason why I say that is the servicers are continuing to pay every month the insurance and the help me with this, Sarah. Taxes and insurance. So they don't want your home to go into a tax lien situation. If the house burns down, they want to be able to have that equity to be able to get their money out. So all this stuff is being paid on your behalf from the servicing company. So if you don't think that there isn't going to be a charge for them to prepay your year's supply. So for example, just for even numbers, so everybody understands, you did a forbearance for 12 months and your house payment is $1,000 a month. Down the road, you will have $12,000 that you have to pay back besides penalties. And I think that's what people don't understand. We don't know what those penalties are. There is no rhyme or reason for what the price of those penalties will be. And you had a good analogy earlier today when you and I were talking, Sarah, about how HOAs were charging large amounts of money. And when the state of Arizona came in and said, we're going to put a cap on it. So then they start charging other fees. So there's transfer fees, disclosure fees, and all other kinds of fees that happen, capital improvement fees, and they can tack on all that money, but it's just called something different. Right. So just be aware, if you or someone you know did a forbearance, it is a short-term loan modification. You either need to make it a permanent one or you need to do some other option. The other thing people need to know is that there are penalties and it does need to be paid back, but there are options for these. And that's where I think that the more we know, the more we can educate and the more we can get people out of these before it gets to the point where all their equity is taken up. Because the sooner they can get out of these forbearances, the more equity these people will have. And we would rather them have the equity than the servicing company have the equity.
Absolutely. Absolutely. So, and you hit it on the head. People have options, but they don't know that they have options. So that's the bottom line. People need to know that they can make some phone calls. There are a number of organizations that are really there to support the consumers. And so I'll make sure that we post, links with CFPB has a great site and lots of options. People need to know that they have people to call and options that can help them stay in their home, but they can't just expect to get it off scot-free.
Right. They have to make that call. They have to find out what the options are, and they do have to work with their servicing company to see what the servicing companies are willing to do for them. So
absolutely.
Yeah.
Yes.
And it does go servicer by servicer. So
yes.
Just because your neighbor did one thing doesn't mean you'll get to do it. So they need to take initiative and they need to be more proactive to make sure that they don't end up in a situation where they do lose their equity or they do lose their home.
Yes. And we want to hear from you. If you are talking to people out there or know what's going on or have other examples of things that are happening in that, kind of forbearance arena, please share with us, because we want to help continue to get that information out there.
Absolutely.
Yes.
Yep. Thank you, Sarah.
Awesome. Thanks, Lydia. I'm glad we did this.
I am too. I'm glad it worked out, and we'll see you next week.
Sounds good. Bye.
Bye.